And welcome back to Halftime Report. I'm Bob Pisani here at the Piper Sandler Global Exchange Conference. This is the annual gathering of the entire trading community. Let's talk with one of those members. Doug Cifu is the CEO of Virtu. It's one of the world's largest market makers. Doug, we're near a new high on the S&P 500, yet all I keep hearing is the retail investors aren't participating as much as they used to. Make sense of the trading. Who's doing the trading right now?
Yeah, well, it depends what you mean by used to. So the volumes are still significantly higher for retail from pre-pandemic, but they're certainly off of the highs. And it's interesting because retail investors tend to focus more in the Russell 2000 names and not the large cap names. So what we've seen more recently is, certainly at Virtu, more of a sell imbalance from retail investors than we saw earlier in the year. And as a result, the rally has been more in the large cap names than in the small cap names. So it's been this divergence in the marketplace between large cap and small cap names.
So the S&P 500 is moving up. Correct. A lot of the institutional investors are in the Russell 2000, so they're missing out on this rally. What's the implications of this?
The institutional investors are participating. Right. So we've seen in certainly the last couple of weeks, volumes have picked up, and institutional investors are moving away from safe harbor investments that were paying 4 or 5% and beginning to participate more in the market, certainly than they were doing in April. Retail investors that tend to focus more in the Russell 2000 names, up until maybe yesterday, those names were not rallying as much.
Right. So the retail trading spiked during COVID. That's sort of dropped off somewhat. And how is the institutional investing affecting trading patterns? You seem to imply the institutional investors are the ones that are really stepping in, particularly in the big cap names.
Yeah, what we've seen certainly from April has been a significant increase in institutional participation. I think a lot of that had to do with the debt ceiling negotiations. People were sitting there saying, I don't know which end is up. I'm not sure there's going to be a default. So there wasn't active participation by institutional investors in the marketplace. Now that you've taken that boogeyman off the table, if you will, we're seeing institutional investors now participating much more meaningfully, but in large cap names, not in the smaller cap names.
You know, one of the big themes here at this conference is the impact of artificial intelligence on trading. Electronic trading changed the world 30 years ago. You were here for that. I was as well. Is artificial intelligence poised to do the same thing? How is that going to change trading, and how is it affecting the way you do business?
Yeah, I mean, we've been using it for years. So artificial intelligence, and more meaningfully, machine learning, is a really, really important part of how we operate. And we offer it to our clients in a very transparent way. As markets have become so much more efficient, human involvement is important, but if you don't have algorithms that are smart enough to adapt real time to the marketplaces, then you don't have algorithms that are going to officially understand and efficiently be able to execute the market in a way that's in the best interest of your client.
What does it mean on a practical basis in terms of market structure? Does it make a market more efficient? Do you execute faster? I mean, what is the practical application in terms of what you do? You run a market-making business.
Yeah, I mean, latency has already been reduced almost to the nanosecond, right? So there's no more, speed has become commoditized. Really what it is understanding the complex markets. We've got a very fractured marketplace with 15 national securities exchanges, 40 ATSs, wholesalers, retail, institutional. So if you don't have algorithms that are able to adapt on a real-time basis to those market conditions, to find the pockets of liquidity to act most efficiently, then you're not executing properly. That's what we are capable of offering as both a market maker and an institutional broker. We offer those products to our clients.
Speaking of algorithms, the number one question I get from the average viewer is, when are we going to get a personal digital assistant that's going to help me trade stocks? I can get Bob Pisani AI that's suddenly going to go into the market and we're going to make millions of dollars on that happening. Do you see that happening, and what impact, if any, would that actually have on people's returns?
We're working on the Pisani AI right now. It has failed thus far.
It failed.
Yeah, it has not. It has not succeeded.
Rejected.
Yeah, it got rejected. Look, I think there's always going to be the need for the human, right? That's going to make that informed decision that can look at macro trends. I always tell people when they come to me for investment advice, buy index products, right? There are really smart people that are trying to pick names, but buy index products. So I don't think that AI is going to replace the stock picker and the human element of the marketplace anytime soon.
Yeah, I don't think if everyone has access to the same information, it doesn't change anything. Correct. Isn't that right?
Correct. I mean, there's such efficiency and transparency in the marketplace today. It's very difficult to think that AI is going to replace, if you will, that human element of the marketplace.
My colleague Scott Wapner has a question. Scott, go ahead.
Doug, good to have you on our program today. I do want to ask you about SEC Chair Gary Gensler, whom you've been especially critical of publicly as well, mostly as it relates, I think, to market structure and payment for order flow and things like that. You've called him, quote, a politician, not a regulator. I'm curious as to what your view is of his crackdown on crypto. I believe you guys must do some sort of crypto trading, some crypto-related business at Virtu. Are you supportive of that crackdown and more regulation in that area?
Yeah, look, we've always been very supportive of regulation and transparency. Certainly, to the extent there are bad actors, it is the chair's job to act as the policeman of the market. Where I have been critical of Gensler, and I think it manifests itself in crypto, is that this is a problem that should have been addressed years ago. Certainly, there should be a joint legislative solution, but to regulate through enforcement, which he's done for certainly the last 2 days, but the last couple of months and couple of years, provides no clarity to the marketplace. There are a lot of good actors out there that think that this is an asset class that should be pursued. And so to have ambiguity and enforcement actions brought, as opposed to some, hey, these are the rules of the road, come in and register, but at least describe what the rules are and provide appropriate forms for registration, to me, that's the job of a regulator. I think it is very political to go on CNBC and say, we already have digital currencies, we don't need any more. That's what the Congress should do, not the head of the SEC.
Sure, but how could you effectively regulate something that is ostensibly so new? To have expected regulation to have been rolled out years ago, how likely could that possibly have been, as we were, I think, all trying to collectively get our arms around what crypto was, which coins were, quote unquote, good versus bad, and how big this industry could be, and what the ramifications would be on the individual investor?
Well, look, the chair has not been shy about proposing regulation. So, 2 years ago, they could have put out a slew of proposed rules in terms of what is a digital asset, what needs to be registered, what's a security in our view, what type of securities exchanges should be covered by digital assets and which shouldn't. The lack of clarity there has meant that the major actors have been hamstrung and frankly don't know which end is up. And the result is going to be, in my view, years of litigation and a lot of wasted lawyer fees, whereas we could have gotten ahead of this in a collaborative, this shouldn't be a partisan issue. It really should be a bipartisan solution.
Let me talk to you. This segment, we usually talk about exchange-traded funds. It's amazing to me they are now 30% of the volume of trading on a daily basis, and, of course, a big part of your business. They used to be vehicles for passive investors, long-term buy and hold. What I see now is active traders, institutional and retail, using them to go in the market, out of the market on a daily basis. Can you give us some observation on how that's affecting your business?
Yeah, I mean, 5 years ago, the notion of an active ETF was sort of a novelty, and now it's a regular part of market structure and what we do. And we act as an authorized participant or a market maker with respect to hundreds of active ETFs. And I think, as you indicated, it provides a lot of benefits. You have daily liquidity, you've got real transparency, there's some tax attributes and benefits to being an ETF as opposed to a mutual fund. So I think that's where the world is going, and you see a lot of asset managers that are embracing active ETFs as a sub-asset class, if you will. And we at Virtu have been very ahead of the curve there, working both with the regulators and with asset managers to come up with active ETFs that work, where market makers can provide real liquidity and narrow quotes, which make them more attractive then to retail and to institutional investors.
I've been covering this business for 25 years, and it's remarkable to watch the ETF business continue to grow. Doug Cifu, thank you very much for joining us. Pleasure having you on here.
Thank you.
Coming up on ETF Edge at 1:15 today, Howard Lutnick, the chairman and the CEO of BGC Partners, and TradeWeb's CEO Billy Holt. We will be discussing recent trading trends in the stock and the bond market, and the big theme here, AI and the future of trading. That's ETFedge.cnbc.com.